Welcome back, you legends. I'm Dr. Khan. Let's get right into this video. I'm going to start this video out with this chart. This is the credit default swaps for the US 1-year treasuries, and they've hit a record high just very recently because of the debt limit crisis. What the heck are credit default swaps? Here's a simple definition from Investopedia. It's a derivative product which serves as a form of insurance against the default of an underlying borrower or debt instrument. Basically, guys, it's insurance against the US government failing to pay back holders of its treasury bonds. And this is a pretty terrifying chart. It's at all-time highs, the record highs for the 1-year treasuries. This is very notable because usually the 1-year treasuries tend to be the lower risk assets in the treasury yield curve. The closer you are on the yield curve, usually you get the lowest risk because you hold these treasuries for a shorter amount of time versus, let's say, a 30-year bond or a 20-year bond. Well, what the heck is happening? Amazingly, Wall Street is strangely calm about the possibility of the US defaulting on its bills. In fact, I covered this exact issue just about a week ago when we noticed big money buying the dip, even though the risk of the US Treasury defaulting has been skyrocketing. Today, the market started with a nice gap up. Then we had a precipitous sell-off all the way to the middle of the day. Then we had a bit of a double bottom and the market rallied back. This entire sell-off occurred because of this. The Biden-McCarthy debt ceiling meeting was postponed. It was scheduled for today, Friday, but now it has been postponed. They're now set to meet early next week. When exactly, we don't know. And this uncertainty has driven the market to rotate into defensive assets like utilities, into defensive sectors like utilities, with financial cyclicals, tech, all seeing pullbacks today. Surprisingly, the Dow Jones actually closed basically flat, so the market is remaining strangely calm about the possibility of the US defaulting. Now, this has been mostly true of the stock market until you pull up the bond market charts. So this is the 1-month treasuries. They've been rallying, nothing bizarre here. Here are the 3-month treasuries, uptrend, a couple of rejections here, nothing notable. But what about the 2-month treasuries? We had a precipitous decline in the 2-month treasuries just the last 5 trading sessions or so. And that's because Yellen has been warning for a while now that the US Treasury is at risk of default as early as June 1st. In fact, Yellen says we have to default on something if Congress fails. US debt crisis could crash the world economy. US default on $31 billion debt may lead to global crisis. All of this extremely negative coverage of what's going on, and yet the market is basically just waiting, doing nothing, with the exception of few big cap tech stocks that I'm going to cover later in the video that have been absolutely melting to the upside. Now, on top of that, we had the Michigan Consumer Sentiment reading come out earlier today, and it came significantly below expectations. So we have consumer sentiment declining, we have the global economy slowing, and on top of that, we have the debt ceiling crisis looming. But yet again, the market just continues to ignore all of these warning signs, buying every single dip to the upside. Look at all of these shooting star candles, right? The market gaps up, sells off, then recovers, sells off, recovers, sells off, recovers. Pretty much every single time the bears start to think that the market is going to break, it traps them at these lows and then moves back up. Now, this cannot go on forever, guys, and the debt ceiling crisis can absolutely be a major risk event to both the bulls and the bears. And here's why. The longer this drags on, the more difficult it will become for the S&P 500 to continue to move up. On the other hand, on the slightest bit of positive news, for example, if we get somehow next week news headlines saying that Biden and McCarthy somehow have figured out a preliminary compromise of some sort, you will see the market go bananas, absolutely bananas, because we've been seeing dip buyers stepping in every single time. So what kind of risk are we talking about? If I pull up this chart again. The last two debt ceiling crises occurred in 2011 and 2013, and I went and pulled the chart for you guys, the S&P 500 chart. Now we had one in 2011, we had another one in 2013, and I boxed both of these to highlight what exactly happened in the market. Now, I should caveat this with the fact that in 2011, the market was actually experiencing a mini recession. So this was a combination of a mini recession and the debt ceiling crisis, and the market had a fit, and we saw a precipitous decline on the weakening economy. Then we had a lot of choppy trading as the debt ceiling war raged on. And now in 2013, the market actually just had a couple of pullbacks here, not a lot going on. Crisis actually began in January of 2013 and it ended in October, so I boxed that exact period. And we only had a couple of modest shallow pullbacks here, 5.5%, again 5.5%, and one final pullback to end the year at just over 3%. So we have two wildly different looks here. We have a market that continued to shrug the debt ceiling crisis, and we had a market that threw a fit. This is the kind of event risk we're talking about. And notice, guys, the credit default swaps in 2013, they have gone up to equal highs to the 2011 levels. So just looking at the credit default swaps and trying to extrapolate some sort of pullback target or something like that's impossible. That does not work. So we have to be absolutely prepared for both outcomes. And there's one absolute best signal to look at to try and figure out how much risk you should be taking in the market in lieu of this looming risk. And it's the VIX, guys, the volatility index. Let me pull up the 1 hour chart here. Here it is. We've been range bound for several days now. Every single time the bears have tried to short the market, sell the market, we had a spike in the VIX. Then we had bulls step in, crushing the VIX and pushing the S&P 500 back up. Here it is, the S&P 500 in black and blue. This has been happening systematically. We open with a gap, we sell off, we recover. We open with a gap, we sell off, we recover. The dip buyers have been absolutely relentless. So how exactly is this going to help us? Well, it's pretty simple, guys. What we're looking for is this. We're looking for the VIX to actually close above this range. At that point, we will know that the equilibrium between the dip buyers and the sellers, the bears, has shifted. With a break to the upside, it will favor the sellers. With a break to the downside, it will favor the buyers. Another absolutely fascinating thing that's been going on with the VIX is this, guys. Notice, this is the VIX trading at the 17 level, a level that we actually haven't seen in the entire year of 2022, and it was the absolute lowest reading before the market put in its final high and before the entire bear market of 2022 began. There has actually been this very strange switch in the VIX since the CBOE introduced the zero data options. We had the market beginning to really bumble along, move sideways, barely making new highs, putting in shallow pullbacks, trapped in this range as the VIX has been getting crushed, absolutely crushed. Now, even in the context of the raging bull market, the absolutely insane bull market of 2021, a 17 reading is still at the low end of the VIX. And what it actually tells us is that the market has been extremely complacent, buying every single dip that it sees. A complacent market is an extremely dangerous market, but a dull market, a market that's chopping, barely making any progress, is also an extremely difficult market to sell and to short. And the April price action has been a prime example of this. Every single sell-off has been bought, every single dip has been bought. And if you actually look back all the way to December of last year, the market has done nothing. It made no progress, just moving sideways, doing nothing. 6 months of absolutely frustrating, dull price action. This is actually very common, guys. This is what I call walking the plank. This is the market begrudgingly dragging its feet, making barely higher highs before the reality of the economic weakness sets in and we get a major sell-off. This is so common, it happened pretty much before every single recession, including the infamous 2000 recession and bear market, where the market was just dragging its feet, making barely higher highs, doing nothing for how long? 200 days, 7 months, doing absolutely nothing, no progress, just moving sideways. And in fact, the chop continues for even longer. Even as the market begins to make lower highs, these lower highs continue to come at an extremely slow pace. Again, if we look back to the left side of the chart, again, 268 days, nearly a year, nothing, no progress. The market just moved sideways. Dumped, rallied, dumped, ended up sideways. Right now, we have a profoundly more confused market. It tested the 200-day, then it broke down, then it rallied again, then it broke down, then it moved sideways. And this could last a long time. In fact, if we just follow the horizontal red line that marks today's close, we go back all the way to February of last year. So we've done nothing in an entire year. 450 days, even more than a year, the market has done nothing. We began with a tradable trend to the downside, then we morphed into this range-bound market. We see the exact same frustrating sideways trading action even on the smaller time frames, including the 1-hour chart. We've been trapped between two gaps, the gap above right here and the gap below right here. The market has done nothing, just moved sideways. Since we had that rally on CPI that we were expecting, we just ended up with a chop fest for the rest of the week. Now, if we take a look at the weekly chart, we ended up with a Harami candle, this spinning top candle, small body and small wicks to either side. The body is red, so it favors sellers. But yet again, we're seeing dips being bought. All of these dips bought. Volume pretty much unremarkable, low volume week. Momentum is slowing down. It is slowly moving down. The PPO histogram is slowly losing steam, but we've not seen any decisive break to the downside like we used to until very recently. Now, there's a tale of two markets, the NASDAQ and the S&P 500. And unlike the S&P 500, the NASDAQ has been grinding higher with a clear price target on the chart that I talked about in the last video. The NASDAQ continues to see volatility contracting, forming what is commonly known a volatility contraction pattern. These are very rare, exceptionally explosive patterns. And even though the S&P 500 has been dragging its feet, the NASDAQ has been inching higher. Now, these volatility contraction patterns do not last forever. They always end with a volatile, very violent move. Now, the volatility contraction pattern is actually an age-old pattern that traders described as early as 1911, believe it or not, but it has been recently popularized by Mark Minervini, a multi-time US investing champion. And in fact, he relies almost completely on this exact pattern to generate his outsized returns. Here it is, pullback, shallower pullback as the market continues to grind its way up in what initially looks like a bearish wedge pattern. Then it hits resistance and it breaks to the upside. Really similar to what we had here. We actually measure the angle of each pullback. You will notice that these angles have actually been getting shallower and shallower. Let's take a look. In December, the market had top to bottom. In December, the market declined in a 70% angle. February to March, top to bottom, we had 35% angle. In March, top to bottom, we had a 26% angle. So not only can we visually actually see with our own eyes the volatility contraction, we can actually measure the exact angle. Now, as every single trader knows, fundamentals always end up overruling technicals. So even if we get a blow off top, a massive breakout, expect that to be a very nasty bull trap, and for the market to eventually end up punishing the majority of traders like it always likes to do. So what is going to take for this to happen, let's say as early as next week? Well, we only need one headline, guys, just one headline saying that Biden and McCarthy have reached some sort of preliminary deal, and you will see the NASDAQ tech absolutely go bananas. And once that happens, do not be surprised to hear that, oh no, the deal fell through, we will come back now. So just be very careful trying to trade this absolutely nutty market. The real strength of this kind of volatility contraction pattern is that you can actually place a very tight stop loss. So you basically buy the breakout, you put a stop loss at the breakout neckline, and that's it. The trade works, it works, you make a lot of money. If it doesn't, you end up taking a very tiny loss because of that advantage of a very, very tight price action and a very tight stop loss order. Another key chart to look at, guys, is the NASDAQ relative to the S&P 500. We're beginning to form this double top formation. It cannot be confirmed until and unless the PPO produces a bearish cross. That hasn't happened yet, but that could happen if the debt ceiling crisis continues to grow, if we get no resolution at all next week between the Republicans and the Democrats. What about the Dow? What's been going on with the Dow Jones? Similar look to the S&P 500, a lot of choppy trading, but more weakness recently that has actually dragged down the S&P 500 and allowed the NASDAQ to rally, right? We had the NASDAQ continuing to push higher as the Dow Jones continued to push lower, and the result is a flat S&P. So tech has been propping up the market and everything else has been weakening. Momentum for the Dow Jones continues to deteriorate to the downside, and the bifurcation of this market with the Dow going down and the NASDAQ rallying is giving both the bulls and the bears something to trade in the meantime as the S&P just chops sideways. Now let's take a look at the Dow theory model. Up top is the Dow Jones Industrials, down below is the transports. We have a bearish divergence. The transports tend to lead the industrials. We had a bit of a bullish divergence here, and then we had that rally on the CPI. In fact, that was one of the small clues that we saw going into CPI and told us that the market was actually underneath, leaning more bullish. Right now, we have a bit of a bearish divergence. The Dow Jones is making higher lows while the transports are making lower lows. This divergence needs to break to the upside for the bleeding in the Dow Jones to stop. Otherwise, you will continue to see the Dow Jones weakening. Up top, high yield bonds, smart money. Down below, S&P 500 dumb money. We had the smart money sell off by a third of a percentage point, equal to the NASDAQ today. Not really a lot, but there is a bearish divergence. If you notice, we made a significantly lower highs than the prior trading sessions, the prior 3 trading sessions, while the S&P actually pretty much made equal or slightly higher lows. Not a massive hint, but it's telling us that risk appetite is shrinking, and we saw that with the market rotating into utilities. This is XLY divided by XLP, another risk appetite indicator that I like to track. XLY is consumer discretionary, and I divide it by XLP, consumer staples, to see the relative performance. And we have potentially an inverse head and shoulders forming here. We had a rally and a break all the way to the 50-day moving average that ended up getting dumped Friday. However, price is still holding above the 9-day moving average, and as long as it can hold above the 9-day, discretionaries like Tesla and Amazon still have more room to rally. Now, if we see a break below the 9-day and we close below it, that would definitely lean more bearish in discretionaries. More likely than not, guys, we will continue to see more choppy trading until we hear from both Biden and McCarthy and whether they hammered out some sort of deal or not. And at that point, we will probably see a break to either direction. Another risk appetite indicator is gold divided by the S&P 500. I use these mainly as buy signals, not as much as sell signals, but they've worked both ways, guys. When gold begins to underperform the S&P 500, that is the market beginning to outpace gold, we usually get a nice rally. And when we get gold beginning to outperform the market, we get a continuation of the weakness in the market. Now, interestingly, this signal hasn't really worked all that great since late March, because gold has underperformed the market, but we really did not get much of a rally, just more and more chop. If anything, the longer this debt ceiling crisis goes on, the more gold will become attractive as a defensive trade. Right now, not so much. Look at this, gold putting in significant bearish divergence, higher highs on the daily chart, lower highs on the price action, and that's very surprising. You would imagine with all of that bearish sentiment around the US Treasury defaulting, you would imagine that gold should be rallying and that the dollar should be declining. We haven't seen that. We haven't seen that at all. We've seen the opposite. We've actually seen the dollar breaking out today, breaking above the 50-day moving average since the highs of February. And if I take a look at the weekly chart, the dollar index is actually broken above the 9-period weekly moving average. Again, for the first time since February, the last time it actually came just after the market put in the top. The longer term trend for the dollar is going to be to the downside. And because as we get closer and closer to the Fed pausing, yields will stabilize. And then as we get closer to rate cuts, the dollar will see more weakness. This whole massive bull rally in the dollar was led by the Fed raising rates. The higher rates are, the more attractive dollars become relative to other currencies. And essentially that's what drove the dollar higher throughout 2022. And so this primary driver of dollar strength is now gone. And so the dollar will inevitably continue to move down. However, in the short term, this quick rally in the dollar is a warning sign that more volatility is about to come. Just be careful unless we get an immediate rejection Monday. If we get a close below the 50-day, we get an immediate rejection Monday on some positive news about Congress coming up with a deal to raise the debt limit, this event risk will be priced out and the dollar should move back down. And as a result, the market should see a quick and violent rally. Now let's talk about a longer term outlook. Up top is Dr. Copper divided by gold, and down below is the S&P 500. These prolonged negative divergences between the copper to gold ratio and the S&P 500 have led to major market tops in the past. And this negative bearish divergence is continuing to build. Eventually, we should see the S&P make one final high and the gold to copper ratio make one lower high and then a major sell-off in the market. This will likely drag on for a while, very likely all the way into the late summer as we enter the new earnings season. Another long-term outlook chart is the value line index up top, the S&P 500. Down below, again, massive negative divergences have led to major stock market tops. We're still seeing this massive negative divergence. We've been range bound for a long while on the S&P 500, and this range will inevitably break. The longer we spend closer to this resistance level, the more likely it is that we actually break to the upside. And that, I believe, eventually will give us the final top for the S&P 500 and one more divergence in the value line index before the market begins that precipitous decline, that recession-led sell-off. The New York Stock Exchange continues to make lower highs as the S&P has continued to make equal highs, pretty much equal highs. Summation index still pointing down. However, if we take a look at the NASDAQ composite has actually been moving up. And in fact, today it only back tested these prior highs and it held these prior highs. The NASDAQ summation index has produced a bullish cross. And so again, we're seeing a bifurcation in this market where tech is continuing to lead despite an extremely narrow breadth in the market, while the Dow Jones continues to falter and decline alongside the Russell 2000. Now, if we see a break above this range, guys, we have a long way to the upside on the NASDAQ composite relative to the NASDAQ 100, which is actually much, much closer to these highs of August, right? The NASDAQ 100 has actually been outperforming the NASDAQ composite, getting much, much closer to the August highs, led by big cap tech companies, some of which have actually already begun forming blow off top melt up patterns, including Google. We had this crazy melt up move, and this is now beginning to look like a blow off pattern, very likely topping at the upper edge of this prior range between 120 and 122. So yes, we could see even higher highs as Google continues to melt up. If we take a look at AMD, another crazy melt up move after this massive dump post earnings, and is now again showing signs of a blow off top. More and more of these stocks, guys, are emerging, including Amazon, which actually has a very similar look to the NASDAQ composite, right? With a much larger upside potential here to backtest these prior highs at 120. In fact, right after Amazon reported earnings, the stock actually rallied all the way to 122 and these prior highs, but it hasn't yet done it in regular market hours. But we see the same old volatility contraction pattern, successive higher lows getting closer and closer to this prior high, an identical look to the textbook volatility contraction pattern, higher lows getting very close to the prior high, with moving averages gaining momentum. Very similar look here, guys. Moving averages now building distance between each other. Moving average is now building distance between each other. Price action has closed above the 5-day moving average. This dark green line, 7 sessions in a row. This has been a very strong uptrend in Amazon, and we're now stalling. Look at that, the prior high. I mean, it looks eerily similar. And Google had a similar look to this. Higher lows, slowly but surely higher lows, even though we had this entire period of weak momentum on the PPO. In fact, I actually ended up going short Google just before earnings. We had that dump, then we rallied, another dump, and I ended up closing that position with a small profit exactly here on May 4th, when it became apparent to me that Google really did not manage to see any significant sell-off despite the negative momentum and has continued to make slightly higher lows. And so when it became apparent to me that despite Google's perceived weakness, struggling to keep up with Apple, Microsoft, Nvidia, all these stocks that have gone absolutely bananas on AI, it just became more and more apparent that sellers did not commit enough, and so I had to exit that position, and I got lucky enough to exit just before this entire melt-up move began. Let's talk about fear and greed. We are at 58. Usually, guys, the market tops around 75, right? Market top around 75, market top around 75. Not there yet. We have actually been chopping sideways just like the stock market, and greed is not letting up just yet. Usually we get a significant sell-off in the market after greed crosses below 50, after we go from neutral to a bit of fear. That hasn't happened yet, even despite all of the negative press around the debt ceiling limit crisis. Let's talk about next week's economic event. Not a lot going on except Tuesday retail sales. So Amazon, Tesla will move on this number. It's a discretionary number, so this is an important number. Then we have Wednesday building permits, not really that important. Thursday, manufacturing index from the Philadelphia Fed, not that big a deal. Then Friday, we have Fed Chair Jerome Powell speaking, and this is going to be a market moving event most likely. But most importantly, it's going to be that debt crisis story that's going to drive the market next week, as well as OPEX, option expiration next week. We have 3.5 million contracts in circulation right now. Maximum pain is at 405. That means the S&P potentially goes back down to 405. But realistically, if I actually look at this chart, 400 looks like the biggest level. So anywhere between 410 and 400. So again, more likely range bound with a bearish bias. Maximum pain theory, guys, is not the gold standard by any stretch of the imagination, but it is helpful, especially in OPEX weeks, which is the third week of every month, to look at these numbers, because more likely than not, if we get bad news, we can look at this exact chart and pinpoint where the market could fall. And that's obvious between 410 and 400. There's a big put wall of 400. So the market will likely struggle to break 400 unless we get something overwhelmingly negative. Otherwise, that's our ballpark, 410, 400 based on OPEX for the SPY. And again, if we get news that some kind of deal has been cooked, all of that goes out the window and you will see dip buyers step back in and push the market higher. So to summarize, guys, next week we have this massive bifurcation. NASDAQ continues to lead, tech continues to lead, Dow Jones Industrials continue to drag the S&P 500 down. We're still in this choppy range. We have a huge spread between risk outcomes next week. On one hand, we have the market potentially seeing significant downside pressure on debt ceiling crisis stocks. And on the other hand, we have another major risk to the upside if we get any positive news about a potential deal being made next week. And on top of that, we have option expiration. And on top of that, we have Jay Powell speaking on Friday. There are a lot of cooks in this kitchen, and I'm super excited to see what they serve us next week. If you enjoyed this video and you want to see me do more of this type of stock market news coverage, in addition to technical analysis, do let me know in the comments. If you want to keep up to date with all of my work and live analysis, you can sign up to join our trading community. Right now, we have 16% off the annual memberships. And if you want to support the channel totally for free, something as simple as slapping that like button is really appreciated. If you watched the video till the end and you did not enjoy it, I thank you for your time and attention. That's all I have for today, guys. Thank you so much for watching, and I'll catch you in the next one. Bye-bye.
Oh, wow.